Hi everyone, welcome to Cyber Trading University. This is an exclusive event that we usually do once in a while on, we have Closing Bell, but we wanted to bring a featured guest in here, Jody Samuels, which I met a few times at the Traders Expo, at the money shows, time to time. And I, get the opportunity. We always want to bring good educators to come in, which are very big contributors to the educated market. And most importantly, what I liked about Jody is that she has a passion and an entrepreneurship of how she applies the trading part of it into trading. And I think that's what everybody is looking for. Most importantly, I hear that, and from what I could see, being a great mentor when it comes to trading, also when it comes into the markets. So like I said, you got to have a very good presentation, run about an hour. It's going to talk a little bit about the Forex market and using Elliott Wave Solutions. So you're going to basically understand a little bit more about trend lines. You'll learn a little bit more about the Forex and futures and stocks and how to apply it again with Elliott's Wave. All right, so without further ado, I don't want to take too much time away from her. And in the meantime, ladies and gentlemen, enjoy the presentation, and thanks for coming. And if you have any questions, feel free to ask questions to Jody as the presentation continues. And I assume she'll be able to answer it best she can. Thanks, everybody, and enjoy it. Stage is all yours, Jody.
Thank you very much, Fausto. I just want to do a sound check. I trust you can hear me and you can see the screen. Okay, well, welcome to the webinar entitled Latching On To Trends, an Elliott Wave Solution. Certainly we've been in trending markets, so this comes at an opportune time. And I want to thank Fausto and Cyber Trading University for inviting me here today to speak to you about a topic, you're right, that I'm ever so passionate about. So thank you for traders for taking time out of your busy schedules to be here today. I truly appreciate that. I think I want to start with a little bit of an introduction about myself to give some context to where I've come from. So I'm just going to continue on down. You can read the disclaimer to yourselves. Before I had a few minutes before starting the webinar, so I did a Google search for the British pound going back to at least 1980, which is when I started trading in the markets. And I found this. It's cited here. I found it on a website. No, I didn't start trading the British pound in 1915. Don't get me wrong. But I did start and I did trade the British pound as an interbank trader for JP Morgan in the red box there. So I traded the pound from 240 down to almost par. Some banks quoted the low as 105. I actually traded at 103. I don't think it's recorded, but I can remember that a client came in and the world was falling apart at that time, so I quoted low and I got hit. In other words, I got some cheap pounds. But I didn't think they were cheap at the time, because we never think, when the market is moving to an extreme, we never think it's cheap or expensive. We just try to go the other way. I certainly wasn't the Bank of England at the time, and I wasn't going to, hold all the pounds that I was given. I did keep those pounds, though, because it was pretty hard not to. And then the pound stabilized and traded back up to the 150s. And that concluded my stint as an interbank trader, trading price action mainly, and quoting customers and making my monthly P&L for the bank. And then after that, I became a position taker and moved up to Toronto to run the trading desk here and all the other, the instruments of the Forex market. So that sort of summarizes my stint on Wall Street to kick off my career, and it has been a full trading career, having spent about 30 years in the industry. And when I look back over these 30 years, I can't think of any period of time when I didn't use Elliott Wave analysis, which is today's main topic. In fact, I won't trade without it. So we have taught thousands of students over the years how to read the market map, how to read the markets with Elliott Wave lenses, and today we're going to impart some of this Elliott Wave knowledge and passion to you, mixed together with some Fibonacci and some other basic analysis, Forex analysis. I'm going to start with some theory followed by an exercise, and then I am going to show you a few of our wave counts on markets just so that you can see where we are in the big picture. So I think I want to say something else. Coming from a bank and learning Elliott Wave at the bank, it really wasn't until I left the bank that I really polished my Elliott Wave trading skills, because I was no longer an interbank trader, basing my trades off of the pulse of the market, feeling the market, and getting given or taken pounds by the millions at on every single price that I quoted. And when you're getting given, a lot of pounds, you just feel that the market might go lower. So when I left the bank, I had to really reinvent myself and try to figure out a way to be able to trade the markets on my own without the reinforcement from the bank, without that reinforcement from all of the great traders around me, without all of the great technicians around me. And that's what I did, and I did that through Elliott Wave analysis. So, long story, I know. Let's continue on. What are the 3 pillars of trading success? I just like to start with this because I really believe that a trader needs to have these 3 things in their trading arsenal in order to be successful and make consistent profits. So we believe that a trader needs the analysis, and that's where the Elliott Wave analysis comes in, the strategy, and the coaching and the accountability. So think of it this way. Without having one of these 3 pillars, it's like going on a hiking trip up a mountain without climbing gear when you're missing one of these 3 pillars. So, for example, many traders think that the strategy isn't enough, but it really isn't. You need the analysis, and you need the coaching and the accountability. In fact, I'm writing a book right now, and it's going to be published, hopefully, I'm knocking on wood, this year by Wiley. And it's all about wearing my coaching hat and why it's so important for traders to really develop good habits when they're trading, when they're in this business. So I'm not going to give too much away about the book, but please be sure to look for it in several months' time. I don't exactly know when it's coming out. Analysis. Let's talk a little bit about the analysis. A key pillar of achieving consistency is to have a thorough knowledge of the market to determine possible future scenarios and be prepared to take advantage of the opportunities that arise. If you're a day trader, you might be looking at the much smaller time frame, so it's very easy for you to miss the big picture. You might be very happy to capture 20 to 50 trading pips in a day if you're trading Forex or points or whatever market you're trading, ticks, and you might be very content taking your small profits during the day. But we look at the monthly time frames, the weekly time frames, the daily time frames to get that perspective. And that's why we do a top-down approach when we do our Elliott Wave counts, starting from the monthly and moving down to the very small time frames. So in our system, we use Elliott Wave, and we've added harmonics. Why? Because both we have found are tied together with Fibonacci, linked together with Fibonacci. And with Elliott Wave alone, we were finding that when we were calling tops and bottoms, we needed to have another confirmation, and harmonics does that. Scott Carney wrote a series of books on harmonic trading, and I find it very, very useful because it is also based on Fibonacci. And of course, I'm sure many of you have read or have seen the Frost and Proctor Elliott Wave Principle book. It is quite complicated to read. The second pillar is the strategy. So many of you have your own strategies, and you learn strategies at Cyber Trading University, and that's great. You might want to add a little bit of analysis with that, and hopefully today you'll be able to add a little bit of Elliott Wave analysis with it. So after a good analysis, Strategy is used to identify the exact entry point, your stop loss level, and profit target. And also, it's really important to know when to trade and when to stay out of the market. So we're going to look at that today because when to trade and when to stay out of the market has a lot to do with trends and sideways moves. Removing the emotions is also a key. What do you do before an announcement comes out? Like yesterday. What day is it today? Yeah, like yesterday when the Fed minutes come out, or the RBNZ talks about interest rates in New Zealand. What do? Do you go into the announcement with the trade? Do you learn how to trade after the announcement? Well, I can tell you one thing. Removing the emotions is really key. And you have to decide for yourself how you are going to trade the news. I don't think I'm going to have time to talk to you too much about that today. But if you do take the position, let's say a swing position, before the news, then you have to feel comfortable with your stop loss. And the way the markets have been spiking these days, during very big news announcements, the market moves several hundred pips following the announcement, and that's the way of it. So if we're not prepared for it, it's difficult to enter after the announcement comes out and the market spikes one way or the other. So the only way that we can prepare for it is to wear our Elliott Wave. Well, that's one of the ways. We do our analysis and use a proper stop loss and keep it wide enough so that we're not taken out of the trade, and that we train the brain to add to the position if the news announcement gives us another entry. So we might want to take a smaller position into news and leave a bigger or wider stop, and then if we do get another entry after news, we can take it. So we don't want to go into news with a full position. Now, I don't know how I got there, but let's move on. 3, coaching and accountability. So it really is important to have a team, a group to evaluate your trades and put it out there. Put it out there in your Skype group, in your trading forum, whatever it is that you do. We certainly have a Skype group, and we have traders posting their trades every day and posting their monthly returns. Why? Because we tell them they have to be accountable to the group. Even if you grab yourself a trading buddy to share your trades with, and plan your goals with, and receive feedback from, that's enough. You just need accountability. Otherwise, we're too much into our own heads, and it's too easy to hide the bad trades and to say, well, we'll do it better the next time. I'm sure you can all relate to that. So get yourself a trading buddy or join a group, but don't be a silent partner. Put yourself out there so that you can learn from your mistakes and you can be accountable to the group. So more on the analysis. Ralph Nelson Elliott was a very interesting guy. He studied various stock markets, market indices over a 75-year period. And could you imagine he did this without a computer? So he was actually bedridden with a virus, recovering, and poring over hundreds, thousands of stock charts. And he discovered that stock markets traded in repetitive cycles. And at the time, they were thought to behave in a somewhat chaotic manner. But in fact, he found that they did not. They traded in repetitive cycles, which reflected the emotions of the investors or the predominant psychology of the masses at the time. We're going to go through the psychology of an Elliott Wave cycle momentarily. But the reason why we want to internalize the Elliott Wave cycle is because it will tell us when we should be in the market and when we should be pausing, when we should be out of the market as well. Fibonacci, Leonardo Fibonacci is really key to this. Elliott Wave projections, Elliott Wave retracements are all based on the Fibonacci sequence. So ratios are determined from the Fibonacci sequence of numbers. which I'm sure you're all familiar with. But Fibonacci is big, and practically speaking, we recognize all of these numbers, and we recognize the retracement targets like 61.8, 38.2, and these retracement targets are just ratios of one number divided by the next number. That will give us 61.8. And so it is important to become familiar with Fibonacci. You all have the trading tool on your trading charts, and we're going to talk about Fibonacci when you look at some live markets. But this is also where it shows up. This is the Elliott Wave 8-wave cycle. 5 waves up and 3 waves down. The 3 waves down is a corrective cycle. That's called a zigzag. This particular pattern is called a zigzag. There are a few patterns, the flat, the zigzag, and the triangle. So, and then we have combinations of those patterns. And that's really all there is to it. But the corrections can get a little bit complex when you do have combinations. But you will get the sense of what feels like or looks like a corrective pattern versus what feels like or looks like a trend move. Now, notice one other thing from this 8-wave cycle. Down at the bottom, let me see if I can use the spotlight here. Down at the bottom, we have numbers from the Fibonacci sequence. So it's all very related. If you're a numbers person, you'll get into this. If you're not, you'll say, move on, Jody. But I happen to be a numbers person, so I think it's just so exciting. This is what turns me on. So we have 5 waves up, and then when we break down the 5 waves, we get 21 waves. And then if we break down those waves, we get 89 waves. So these are all of the numbers from the Fibonacci sequence on the left side in the trend market. And we can count them: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21. And then if you break, I'm not going to count 89, but you see where I'm getting at. So what that tells us is that these patterns, and we'll talk about this shortly, show up on any time frame in any market, and it works in any market. So whether you're trading stocks, futures, commodities, currencies, agriculturals, whatever it is you trade, you will see Elliott Wave patterns in those markets. The corrective wave cycle is also based on the Fibonacci sequence. And then when you add up the trend move with the corrective move, you also get numbers from the Fibonacci sequence. All right. Moving on to fractals. Elliott wave theory is successful because it is based on the science of chaos, which describes how complex shapes look the same at various orders of magnitude. So what that means is, if looking at the branch of the tree, if you break off a branch of the tree, it's going to look very similar to the whole tree. And all of these patterns, if you take a cloud, it's going to, when you look at the sky, you're going to see, well, I don't know that much about clouds, so really what am I talking about? But you're going to see the same patterns in small groupings, in larger groupings, and in larger groupings. Maybe it's easier to see when you're flying in a plane. But let me try to explain that better here. We can even look at fractal images, which is a special image that is generated using a simple mathematical formula that stems from Fibonacci, just like nature. All of those patterns in nature stem from Fibonacci. And if you take a smaller portion of the image and then magnify it, you will find a new image within, which is just exact. So here is an example of a fractal image where if you take a smaller portion of the image and then magnify it, you will have a new image with the same structure. This is a fractal image. And here's another one. And what this means is, once you train yourself to see patterns in the market, you'll see them repeated in any market and in any time frame. So when you hear the word fractal, just think of the markets repeating and the Elliott Wave patterns repeating in all markets and in all time frames, which means that you can be a day trader, a swing trader, a position taker, trading off of the same patterns. It really doesn't matter. Let's segue right now into trending versus sideways markets. Let's talk a little bit about that. And one of the keys to trading well is to identify the trending versus the sideways markets. You know that there are only three things a currency pair or any market can do for that matter: go up, go down, or meander along in a correction, go sideways. That's all it can do, right? Sounds simple enough? Not so, not so. This picture illustrates the fractal nature of the markets as well, and looking at the bigger time frames to get perspective. We just said that the markets can go up, down, or sideways, but guess what? The red line here is the long-term trend. So that might be the monthly or the weekly or even the daily. Let's say it's the daily. So we see that the trend is up. And then we move down to the green line. Let's say that's a 4-hour chart. The 4-hour will cycle within that daily. And then let's say the dotted line is the 15-minute chart. The 15-minute will cycle up and down within the 4-hour. So if you're just using your glasses to identify the sequences on the 15-minute time frame, you might miss the boat. You might, so for example, let's look at this segment right here. This looks like a complete 5-wave cycle. It's done, and then we have a correction. But if you're not looking at the bigger picture, then you might miss the correction to go long. So it's really important to get that bigger picture in mind and to also get some projections. We're going to talk about some projections today. And also know that it's possible that the short-term trend will be down at various times in the market cycle, because that's part of the market cycle. And the key is to buy in an uptrend or to sell in a downtrend, and know how to maneuver within these market cycles. That's really key. The next slide, it's interesting how I have to get out of this spotlight mode to go on. I click for the next slide. Okay. So the next slide is the end of the trend. It illustrates the end of the trend, because there you might say, fine, well, Jody, how do we identify the end of the trend even on the smaller time frame that we're trading? Never mind on the bigger time frame. How do we know that if we're a day trader, how do we know that the market is going to turn around and have a correction? Because we don't want to be in it if the market turns around and corrects. We want to be out of it. We want to take our profits. Well, one of the best ways that I found is a 1, 2, 3 reversal. Let's just talk about that. The market is trending down. It's trending down. And when we are in a downtrend, we want to be selling. Every time the market wants to move against us, we want to sell. Okay, sell on strength. And I can remember telling my traders the same thing 25 years ago. Sell on strength. Sell on strength. Buy on weakness. Nothing has changed in all of that time. Plan your trade and trade your plan. I can remember saying this to my traders. I'm not kidding you. 25 years ago, plan the trade and trade the plan at the bank. All right. So when we're in a trend, let's say this downtrend, we want to plan our trade to be selling on strength. plan it, because if we don't plan it, our head isn't going to be in that mindset to sell when the market is going up. We're always going to be thinking it's going to go higher. That's why we have to really, really look at the bigger time frame to know and to have a method to get in when the market is finally trades down. And that can be through candlestick analysis, it can be through your chosen strategy, it can be through any number of ways. So we use a combination of moving averages and price action, and I find that the moving averages are a really good way to keep us in the trend. But now let's talk about the end of the trend and the psychology and what happens there. The market is trending down, then the market moves up, and then the market comes to a fork in the road. And at this fork in the road, the market can either move down and make a new low or trade up and start a trend in a new direction. Right? That's the only thing that it can do. Or it can trade sideways for a while. I guess that's the third thing it can do. So one of the best ways that I know is to look at a smaller time frame and look at that for that 1, 2, 3 reversal. And the 1, 2, 3 reversal is as follows. You label the low 0.1, and then you label the first move up 0.2, and then this would be 0.3. And if we move up and take out the top of 0.2, well, then we've changed direction, because this is the definition of an uptrend, higher highs and higher lows. So that's one way to do it. The other thing that we like to see at the end of the trend is divergence. So I don't use oscillators for overbought or oversold. I look for divergence in the trend move. And when I see divergence, that gives me a clue that I'm looking for a change in trend. Now, sometimes in a very strong trend, we have triple divergence, and that's fine too. But we know that if we do make a new low, then we have to do this exercise again. We have to continue to go with the trend down and then wait again. Go through the exercise again. This is the 5-wave trend cycle, the basic wave patterns. And let's talk about the wave personalities now. I said I wanted to talk about the wave personalities, and I do. So we're reviewing the market cycle. And this is the 8-wave cycle that we saw. At the beginning of the 8-wave cycle, this is the end of the trend, 0.0, the market is still bearish at this point. Why? Because we've just come down. So wave 1 moves up, and then usually wave 2s are pretty steep, and that's where we see our double bottoms. And this is really, it's a very good way to enter, because you enter at a good price, you leave your stop below the lows, and you're at the beginning of the move. The risk is that we're going to make a new low. This is the exact same picture that we saw on the last slide. So just imagine that we've come down, we've moved down, in a downtrend, the market moves up, sellers come into the market, and that's why wave 2 corrections are usually steep. And we usually see zigzags, a zigzag where we have an initial move down followed by a small correction and then a third move down, leg down. So that's the personality of the beginning of the move. Now once we take out the top of this wave 1, we're into wave 3 territory. And wave 3 can have the main personality is that it's the strongest move when we're in a strong trend, and the slope is steep, so you're going to see a very steep slope, and we'll see that today when we look at some markets. You're also going to see, what else? That the corrections are very shallow, so the corrections are going to be less than 38.2%, most likely much less than that. And you're just going to have to, buy on dips for this wave 3, or just buy on this wave 3. And as long as you have your projections in mind, then that's what you need. You need to have your projections in mind to see how far we can go. Now let me tell you a little trick about wave threes. Not all wave threes are created equal. That means that not all wave threes are 5 waves. Wave 1, 3, and 5 are 5-wave trend moves. However, sometimes we get an extended wave 3, and this is how I play the extended wave 3. If I see an initial 5-wave sequence, and then the market retraces, and it takes out that high, then I know that the market is going to extend. And it extends in 4s. So if we have a 5-wave move, and then the market corrects and then makes a new high, we're going to go from 5 to 9. That's how we're going to go. So 1, 2, 3, 4, 5, 6, 7, 8, 9. And then we run through the exercise again. If the market comes down and makes a new high, we're going to 13. We add 4. So 9, 10, 11, 12, 13. In terms of wave extensions, we can go to 17. We can go to 21. That's what we can do in a wave 3. And you will see that in some of the markets, now because we've had such strong trend moves. The other way to know if a correction is going to be, a wave 3 is going to be extended or not, is through the use of Fibonacci. So this is using waveform to see that, but you can confirm that using Fibonacci, in particular Fibonacci extensions. So the most common extension for a wave 3 is 161.8 times wave 1. And you use your Fibonacci tool to measure that. Once we go above 161.8, then Elliott Wave traders are going to look for the next level, which is 261.8. And then once we go above that, we're looking at 423.6 times the wave 1 move. So now we've introduced a second way to calculate if the wave 3 is going to be extended. 1, by form, by counting the waves, and 2, if we go above these Fibonacci levels. And that's how traders think. Like that's how you can train your brain. You can say, okay, we've hit the 161.8 target for the wave 3. We're through it. Guess what? We're going higher. We're going lower to the 261.8. So that's the wave 3. During wave 4s, we have a correction, and this is when a lot of traders take profits. So you have your institutional traders that have been in early or not taking profits. Mainly, traders will take profits here because they see it going down and they don't want to give back their profits. But what also happens during wave 4s is it can be very choppy, and traders tend to buy high and sell low during wave 4s. So you need a way to stay out of the market if that's your thing, buying high and selling low. I hope not. If it is, you need to work on that. and then the next move, which can also be quite profitable, is the wave 5. So wave 5 is characterized by blow-offs in commodity markets, for example, and that's where the wave 5 is strong. In currency markets, the wave 5s tend to be shallower, not always, but sometimes they are, and we might have a 5th wave failure, or we might have an ending diagonal, which is a weak wave 5 before the market corrects. Okay, so wave 5 is the trader's last chance to capture the trend move before we have a deeper correction. The other thing that I want to talk about is this zigzag correction, because this can be an excellent trading opportunity for you. This is actually one of my favorite choose pen color, favorite patterns, and this is also called the flag pattern in classical technical analysis. By the way, I had the biggest aha moment when I realized that all of these Elliott Wave patterns are can be explained through classical technical analysis. So the flag pattern is the zigzag. Okay, the triangle is the triangle. The flat correction is the box. So I love that. Anyway, this is your flag pattern. And how do we trade this pattern? Very simply, we have a trend move down for an A wave, and then wave B corrects, and it's going to look like a weak correction, presumably. Ideally, not though, trade between. Ideally, it will trade between 38.2 and 61.8%, and then you get ready to sell for the wave C. Okay, this is called the equality trade, and the equality trade says that wave C will be at a minimum the same length as the wave A. So you can measure your profit-taking objective just by looking at the wave A. But very often wave C has the same personality as a wave 3, and it goes beyond 100%. It can go to 161.8%. That's pretty normal. And it can also be less than 100%. It depends how strong the trend is. But this is a real, excuse me. This is a really nice pattern to trade, the ABC pattern. And that way you don't have to think too much about the Elliott wave count, because the ABC it shows up everywhere, and it can be a 1, 2, 3, it can be an ABC. It's basically a 3-wave move. Whoops. I think we need to find an eraser and erase that. There we go. Okay. All right, now we're going to talk about another topic. Let's just talk a little bit about trading styles, and then I'm going to run through an exercise with you, and then we're going to look at live markets. I guess I better keep going quickly, huh? And then I want to also show you something that we're offering you today at the end. All right. There are basically four different trading styles. Scalp and momentum trading, day trading, swing trading, and position taking. And I like to think that, I like to tell traders that if you can make between 100 and 300 pips a month, and I know you're thinking, a month, that's all? But if you can do that and use proper money management and know how to use your leverage properly, you can make a good living, 100 to 300 pips per month. I used to say between 200 to 400, and I could probably move it back up to 400, 100 to 400. That's fine. But it's funny, I've been in touch with the trader who is thinking about taking our training, and he said that he made 800 pips one day last week. And my mouth just dropped. I said, 800 pips? What are you talking about? 800 pips? So why do you want to take my course, 800 pips? And I kept emailing him to get clarification, and I don't know if he's just very humble, but he, he just works very hard, and he trades many different markets all at once. So I just said, if it ain't broke, don't fix it. My gosh, 800 pips. Anyway, I recommend that traders make between 100 and 300 or 100 and 400 pips a month consistently. So what that means, as a position taker, you might take one trade or a couple trades in a month and make that. Now, in these markets, you can certainly make more than that. So that's why when I did the slide, it was really it was before the market volatility increased tremendously. So it is possible now to capture more than this. But let's just say, on average, if you can do this a month, you're a solid trader. So I like to tell traders to look at 3 time frames for their top-down approach. So if you're a position taker, that might be the weekly, the daily, and you would trigger trades on the 4-hour, for example, or even the daily. But you're looking to make this P&L. If you're a swing trader, you might be looking at making 50 to 100 pips per week. So that would be 200 to 400 pips per month, right? Looking at the daily, the 4-hour, the 1-hour, triggering on the 1-hour. If you're a day trader, you're looking at making 20 to 50 pips a day, or 20 to 40 pips a day. So that would be 100 to 200. Yeah, okay. Yeah, this is going to be a bit more. But naturally, we have to figure that we're going to have losing trades as well. And we're going to have losing trades, so we have to factor that in as well. And I'm not going to get into that calculation. All of this is net, okay? If you're a scalper, momentum trader, you're looking to make 10 to 20 pips a day, it all adds up to the 100 to 400 pips a month. That's what it adds up to. And anyway, I just wanted to get that in. Okay, let's do our little exercise now. Here is a different, we're talking about new paradigms, a different way of looking at the same picture. What do you see here? Do you see a Mexican serenading his girlfriend, or do you see an elderly couple? You might see different things depending on how you're looking at this picture. Well, the same too with the markets. You might see different things when you look at a picture, when you look at the markets. So let's do this exercise now. What do you see here? Some of you will see waves 1, 2, 3. Others will see waves A, B, C. Still others will see trend, correction, trend. On another level, you might see a way to make profits from the markets day in and day out. You might see the trend is your friend. You might see buyers versus sellers and learning who is in control. You might see a 1, 2, 3 reversal pattern. You might see an A, B, C, D harmonic pattern. You might see this as a zigzag. You might see this as a flag. You might see this as a market fractal. No matter how long you've been trading for, you see these patterns over and over again in every single time frame. So bear with me. Here we have a blank chart, blank to the naked eye, and we're going to start at this point right here. And what do you see? What do you see? Well, we just went through a number of things that you see. Now let's dress up the chart a little bit. And now we see a 1, 2, 3 reversal pattern. We're using different lenses to see the same chart. Okay. So now we see a 1, 2, 3 reversal pattern, which we have already discussed, and you would buy above 0.2. Let's dress it up a little bit more. Let's see an equality trade, where we also talked about the equality trade, where we have a move off the bottom, we have a correction, and then we have another move equidistant to the first move. That's the equality trade. Now, I did say that I like the move back to be in between 38.2 and 61.8. In this case, we almost double bottom. Why? Because it's the start of a new trend. You can see that. We also discussed that wave 2s are usually steep. Let's put on another lens, lens 4. What about an equality trade with the Fibonacci expansion tool? And with the Fibonacci expansion tool, we can get some projections. 100% equality, 127.2%, 161.8%. So now we're starting to get some targets for our move. Now this is one of our setups. It's called the fill the gap setup, where you are looking for a move back to the tunnel, okay, after you see divergence. So we're putting on another lens now. And Now we're adding the Fibonacci expansion tool on this picture, and we see that the Fibonacci expansion tool at 161.8% lines up with these moving averages, these long-term moving averages up here. So we're doing this exercise because we're starting to gain clarity of thinking about our profit targets. So we're not thinking so short-term, we're thinking more longer-term. And it's just an exercise how everybody looks at the market with different lenses. Here's lens number 7. This is another setup that we have for people who, in my group, who like to really look at a lot of indicators on the chart. And so this is called the bungee, and these are called the semaphores, and the semaphore lines up at the moving average as well, and the starting point is another semaphore, the royal semaphore we call it. Lens number 8. What about a harmonic pattern? Adding a harmonic pattern to see where point D can end up. And now let's add this harmonic pattern with the wavy tunnel, with the moving averages. So once we get a number of confirmations lining up at the same profit target, and you can do the analysis right at the beginning of the move, it gives us more confidence in holding the position longer. Now, I recognize that this might even be a short, this is the daily chart. We haven't even looked at the monthly or the weekly, but this is about as far as I go for this exercise. And then when we add the wave counts, it gives us even more perspective. The wave counts is telling us that this is an A, B, and we're looking for a wave C up. So we've just looked at 10 different lenses to look at the same picture, and depending on what you learn and how you trade, it really doesn't matter as long as a trader you get confidence in how you're viewing your market map. And how you get confidence is really a personal thing. It's not that you're going to use or that you have to use all of these 10 items on your checklist, but what it does mean is that you should have a checklist of things that you look for, things that will help you to project your moves, things that will help you to set your profit targets, things that will help you to start your stop losses, and things that will help you to anticipate the market moves. Okay, why don't we take a look at some live markets now, and then I'm happy to take some questions too. So I don't see any questions right now, but we'll look at some live markets. Now what I've decided to do, actually let me just, what I've decided to do was to show you the long-term charts, the monthly charts, to get some perspective. And then after I show you the monthly charts, I'm going to show you a way where you can download a video that our Elliott Wave strategist, Juan Maldonado, produces for our trading services, and I'm going to give you access to that video for the next few weeks if you sign up for it. He has one in there for this week, so you can see how his calls were. Posted it before the trading week. So in that video, Juan goes through all of the smaller time frames of many different markets, currency pairs, the S&P, gold, oil, and shows you what we're thinking about for the coming week. Okay? So I'm going to just talk to you about the monthly time frame, the bigger time frame. This is the euro. And this is the big picture. Now I have the Elliott Wave counts on here. I just want to show you that the first thing to look at is we had a triangle formation, and this has been our wave count forever, the euro triangle. And once we broke down through the trend line, we started to move. Now naturally the fundamentals were in play here, the end of QE, etc., and slow down in the euro economy. But the Elliott Wave analysis it really shows what is happening in the fundamentals as well. So knowing what's going on with the fundamentals can give you more confidence in your Elliott Wave count. So we look at the fundamentals, we look at the news, and it gives us more confidence in our Elliott Wave count. We don't want to go against the fundamentals. So we were calling this